So 2009 question paper. The balance sheet of a manufacturing company for the year ended 31/3/2008 and 9 are stated as follows. Fixed asset, there was a change in the fixed asset compared to last year and the current year. So you need to prepare fixed asset account. The reason is there is an adjustment related to fixed assets. So you need to prepare fixed asset account. Stock is a current asset. It will come in operating activity. Last year 23,000, current year it's 55,000. It means there is a purchase of stock. So whenever you purchase stock, you need to pay. So you should minus. Simple. If current asset increase minus current asset decrease, you should add. So increase in current asset of 32,000, add. Debtor will come in operating activity. It is a current asset. Compared to last year, current year 7,000 decrease, add. Cash, opening cash 39,000, closing cash 47,000. So our final answer should match with 47,000. Outstanding rent, it's a asset, means rent not received. It cannot be treated as an expense. Here rent is receivable, it's given in asset side. Therefore it is treated as an income. It is an asset. So therefore, compared to last year, current year, there is an increase of 6,000. So 6,000 increase in current asset, you should minus in OA. Salary paid in advance is nothing but prepaid salary. Salary paid in advance is a current asset. Compared to last year, current year, there is a decrease of 4,000. So 4,000 decrease in current asset, you should add operating activity. Preliminary expenses 45,000 last year, current year 30,000. That means 15,000 is written off. So prelim expenses written off is 15,000. OA you should add. Share capital. Compared to last year, current year, there is an increase in share capital of 2 lakh. So 2 lakh is called as issue of shares. It will come in finance activity. Profit and loss account. Last year 1,50,000. Current year 1,75,000. It means net profit is 25,000. 1,75,000 minus 1,50,000. GR 50,000, 70,000. That means there is a transfer of GR to the extent of 20,000. It should be added in OA. Next, provision for tax 30,000, 25,000. It means you need to prepare an account because there is an adjustment related to provision for tax. Long-term loan. Last year 2 lakh, current year 1,50,000. It means loan is repaid. You should minus in FA. Creditor is a current liability. It will come in OA. Last year 32,000, current year 44,000. That means 12,000 you should add. Bank overdraft. Last year 15,000, current year 17,000. Increase in bank overdraft you should add in OA. Outstanding wages is a current liability. There is a decrease in outstanding wages of 4,000. You should minus in OA. Additional information. Depreciation for fixed asset during the year is 90,000. So you need to prepare fixed asset account because there is an adjustment. So 90,000 depreciation on fixed asset will come in fixed asset account and OA. Plant worth rupees 50,000 was sold for a loss of 15,000. 50,000 plant is sold at a loss of 15,000. Then for how much did you sell? 35,000. How? 50,000 is the original value. Deduct the loss 15,000. Then you should have sold at 35,000. So 35,000 is called sale value. It will come in plant account and investing activity. Loss 15,000 will come in plant account and OA. It's called loss on sale of plant. Tax paid during the year is 9,000. So total tax paid during the year is 9,000. It will come in provision for tax account and investing activity. Next. Provision for GR 20,000, ignore, it is not an adjustment, it's a information. Already in the balance sheet we found 20,000 GR is transferred. Preliminary expenses written off during the year is 15,000. It is not an adjustment, it's an information. Already prelim expenses written off which we discussed in the balance sheet is 15,000. Prepare a statement of cash flow as per accounting standards. Fixed asset account you need to prepare. So plan to balance brought down 18 lakh 10,000. It's called opening balance. Fixed asset also includes plant. So we don't have separate plant and machinery in the balance sheet. So fixed asset in that plant is included. So by depreciation on fixed asset 90,000. Then by balance carried on closing balance of fixed asset 19 lakh 90,000. Then sale of plant 35,000, loss of on sale of plant is 15,000. So credit side total is more, 21 lakh 30,000 minus 18 lakh 10,000. You get difference 3 lakh 20,000 is called purchase of fixed asset. Provision for tax account is a liability. By balance brought down 30,000. Next to income tax paid, when you pay it is an expense, debit all expenses and losses 9,000. Then to closing balance 25,000. So you get 4,000. That is called new provisions created. So it should be transferred to PL account. Calculation of cash flow from operating activities. So net profit as discussed, current year profit minus last year profit, you get 25,000 net profit. Add decrease in debtor, add decrease in advance salary paid, add increase in creditors, add increase in BOD, add preliminary expenses written off, add GR transfer which they are given even in the adjustment called provision for GR. Next, provision for tax 4,000. It is called tax created, new provision created 4,000. Depreciation on fixed asset should be added. Loss on sale of fixed asset should be added. So you get 1,94,000. Next, less increase in outstanding rent 6,000. Less increase in stock 32,000. Less decrease in outstanding wages 4,000. So students, you get an answer. Cash flow from operating activity 1,52,000. So calculation of cash flow from investing activities. So we have sale of fixed asset, that is plant 35,000, less purchase of fixed asset, which we got the answer in fixed asset account 3,20,000. So you get an answer of minus 2,85,000. This is called cash flow from investing activity. Next, calculation of cash flow from finance activity. So we have issue of share capital 2 lakh, less long-term loan paid 50,000, less income tax paid 9,000. So you get 1,41,000. So final statement, cash flow statement. So cash flow from operating activity which we found 1,52,000. Cash flow from investing activity minus 2,85,000. Cash flow from finance activity plus 1,41,000. So if you adjust all these three, you get net cash flow 8,000. Add the opening cash balance 39,000. We get the resulting closing cash 47,000. Thank you.